All right, today we're doing a deep dive from HDIN Research on a company called Eos Energy. Their big bet? Well, it's that a pretty common metal, zinc, might just hold the key to solving one of the electric grid's biggest and most dangerous challenges.
I mean, think about that question for a second. It really gets to the heart of a potential revolution in energy storage. It's a direct challenge to the lithium-ion batteries that, pretty much dominate the market today. It forces us to ask a really important question. Is there a fundamentally safer, more resilient way to build the grid of the future?
So, to really get what EOS is trying to do, we first have to understand a pretty big vulnerability in the technology we all rely on right now. And it's a problem that, it literally keeps grid operators up at night.
Okay, so here's the deal. The industry standard right now is lithium-ion, and it carries the significant risk of something called thermal runaway, which is basically a fancy term for a dangerous self-sustaining fire. To handle that, you need all these complex, expensive cooling and fire suppression systems. We call that an active defense. But EOS's technology, this aqueous zinc battery, it's totally different. It's designed with what we call intrinsic immunity. It's just non-flammable by its very nature. And look, this isn't just some minor feature. We're talking about a fundamental re-architecture of battery safety. When you eliminate the hazard at the chemical level, you can potentially get rid of all those costly support systems. And that has massive implications for both the cost and, frankly, where you can even put these batteries.
Okay, so that's the big claim. But how exactly does EOS pull this off? What's the secret sauce here? And maybe more importantly, what are the trade-offs that come with doing things so differently?
It's actually a remarkably robust and simple approach. I mean, they're using Earth-abundant materials like zinc salts in a water-based system. So no cobalt, no nickel. The battery can operate across this incredibly wide temperature range. We're talking -20 all the way up to 50 degrees Celsius, which means you don't need expensive air conditioning. And get this, no pumps, no moving parts. It's a completely static design, which just slashes maintenance costs. And this slide right here, this brilliantly shows their focus on execution. Moving from their older platform to the new Z3, it's just a massive leap forward in how they can actually build these things. They've cut the number of cells in half. They've reduced the number of welds by a staggering 98%. And they've doubled the energy density, all while getting the manufacturing time for each one down under 10 seconds. This stuff is absolutely crucial if you're ever going to scale production efficiently.
Okay, but let's be real. Promising technology is one thing, building a viable business is something else entirely. So now let's turn our attention to the 2025 financials and see what the numbers are really telling us. All right, let's start with the top line. For 2025, EOS brought in $114.2 million in revenue. Now, on its own, that number tells you, okay, their production lines are starting to deliver. But that's not the real story. The real story is the growth rate. Yeah, that revenue represents a 632% year-over-year increase. I mean, a number that massive signals two really important things. First, there's incredibly strong market demand for what they're selling. And second, they're finally having a serious, hard-won ramp-up in their ability to actually build and deliver it.
But here comes the reality check. Their gross profit, it was a negative $143.8 million. Let that sink in. This means the cost to actually produce and deliver these systems still far exceeds the money they're bringing in. They're literally losing a ton of money on every single sale at this stage.
So all of that leads to an immense net loss of $970 million for the year. Look, a cash burn that staggering would be a death sentence for most companies. But for EOS, it's actually part of a deliberate strategy, a high-growth, high-investment push that is focused entirely on scaling up their manufacturing. Now, obviously, a loss like that is completely unsustainable without a major influx of cash from somewhere else. So, where is all that money coming from?
Well, a critical lifeline is coming directly from the U.S. government. EOS secured a loan facility of over $300 million from the Department of Energy. And let's be clear, this isn't just a bailout. This is a strategic investment to fund what they call Project AMAZE, and that's their plan to build a massive 8-gigawatt-hour factory right here in the U.S. by 2027. And it's not just direct loans. Federal policy is a huge financial lever here, especially the Inflation Reduction Act. So in 2025, EOS got over $21 million in production tax credits. That directly lowers their manufacturing costs. And at the same time, their customers get an extra 10% tax credit just for buying a Made in America product, which of course makes EOS more competitive. When you add it all up, they raised about $1.5 billion in capital in 2025, and that has, at least for now, taken the immediate risk of running out of money off the table.
But even with that huge war chest of funding, the path forward is, well, it's far from certain. Here at HDIN Research, we see what we're calling a triple threat. 3 core risks to their long-term success.
So, what are they? Well, these are the 3 big hurdles that management absolutely has to clear. First up is execution. Can they actually build and run that massive 8 gigawatt-hour factory without major problems? Second is competition. What happens if lithium prices keep dropping? Can they still compete? And third, financial discipline. Can they finally break out of this cycle of high cash burn, the one fueled by those negative gross margins we just looked at, and can they reduce their dependence on just a handful of huge customers?
And this slide, wow, this really exposes that third risk perfectly. This is their revenue breakdown for 2025. Just look at it. A single client accounted for over half, 51.5% of all their revenue. That is an extreme level of customer concentration, and it's a massive vulnerability for the business.
All right, so let's bring all these pieces together. We've got the innovative tech, we've got the really challenging financials, and we've got these significant risks. So what's our final analysis here at HDIN?
Our verdict really comes down to this one crucial point. For EOS, the future is no longer about the science in the lab. It's all about execution on the factory floor and discipline on the balance sheet. The market, for the most part, has bought into the technology story. Now the company has to prove, and I mean really prove, that it can convert all those orders into profitable cash-generating deliveries at a massive scale. And really, that brings us to the multi-billion-dollar question for Eos Energy, doesn't it? Can their operational execution outrun their cash burn? The answer to that question is going to determine whether this company, and hey, maybe even zinc technology itself, becomes a cornerstone of the future grid. Thanks for joining this HDIN Research Explainer.